Hello, my name's Clive Thompson. Hello, dear viewers. Today I'm going to tell you the story of Sam Bolton Jr., who died a horrible death by jumping into a vat of boiling beer after losing all his money on the stock market. This story takes us back more than 100 years to 1901. Those who understand the booms and busts of history are better equipped to understand the booms and busts which we're going to see in the future. This is a story of rags to riches, and then in a flash it was all gone. Samuel Bolton Jr.'s father, Samuel Bolton Sr., was born in the UK. In 1848, seeking better opportunities for himself and his family, Samuel Bolton Sr. moved himself and his family to the USA and ended up in Lansingburg, which is now part of Troy in New York. His son, Samuel Bolton Jr., who's the subject of this story, was born a few years later in 1851. Samuel Bolton Sr.'s occupation for 19 years in America was working for an oilcloth manufacturer, but he had a side hobby which was brewing beer. But his beer became more and more popular, and eventually he gave up his day job to concentrate on brewing beer. His beer was so popular that he could expand rapidly, and his beer won many prizes for being the tastiest and best and purest beer in the region. By 1897, the brewery was run by Samuel Bolton Jr. Sr.'s two sons, which was Samuel Bolton Jr., the subject of this story, and his brother Joseph. Samuel ran the commercial and financial side of the business and rapidly became a wealthy man. He bought a lot of real estate and became involved in lots of businesses in Lansingburg, New York. He ran multiple business interests and was highly respected by the community. He was one of the largest taxpayers in Lansingburg. He was described at the time as being a millionaire, although it's hard to know exactly what that meant at the time, but I suppose it's similar to being a billionaire today. This story isn't just about Samuel Bolton Jr., it's also about the backdrop to what caused him to throw himself into a vat of boiling beer. We're going to be talking about something called the Northern Pacific Corner of 1901. This story covers the first 10 days of May 1901. On the day before our story ends, Sam Bolton Jr. took off his hat, his coat, his pocket watch, and his notebook, laid them on the ground, and was later found floating in a vat of boiling beer. It was concluded that he had committed suicide. Despite Sam's skills at making excellent beer, excluding the floating body, he wasn't much good at picking stocks, and I'll come back to that later. The one thing that he didn't perhaps understand is that when you sell a stock short, your losses can be unlimited. Your maximum profit by selling short is 100%. Your maximum loss can go to the moon. There is no limit. In the early 1900s, railway stocks were all the rage. Railway lines stretched out from major cities like arteries, joining up with other major cities. Each railway company wanted to control and own the others. Railway stocks were like the dot-com bubble of the late 1990s, or the AI bubble, if it is a bubble at all, we'll find out, of 2025. Railway company stocks offered immense opportunities for profit. The railway companies were fueling the second industrial revolution, enabling the transportation of goods, of lumber, of animals, of telecommunications equipment from one city to another across America. The 40 transportation stocks were very hot bets. This can only be compared to the bets being made on the dot-com companies in the late 1990s, 100 years later. The talk at every dinner table was about the 40 transportation stocks and how you couldn't lose by buying into the future through them. For several years, the transportation index had been rising rapidly. In 1897, the index was up 18%, 1898, 17%, 1899, 16%, and 1900, 26%. But 1901 was the year that stocks rocketed. The 40 transportation stocks by May 1901 were up another 34%, or 50% over the preceding 12 months. It was hard not to make money in stocks. Adding fuel to the fire and the fury of this investing were the battles going on between the railway magnates as each railway company tried to take control of the others in order to build and grow their empire. Throughout the country, men, women, and even children had been tempted into the lure of instant profits. It was hard to ignore the promises of fortunes to be made literally overnight. Back in the 1900s, leverage was used everywhere. Brokers allowed 10 times leverage, and bucket shops would allow up to 100 times leverage. The vast majority didn't know the difference between long or short. All they had to do was bet on the direction and get rich if they got it right. Everybody seemed to have figured out some sort of system. Rules like, if it went up yesterday, it's going to go up today. Or, if it went up yesterday, it's going to go down today. Whatever people's idea was, they were trading like crazy. They didn't know the difference between long and short for the most part, and certainly very few could have understood that when you go short, you can lose more than the bet you have made. As always, stocks were driven by greed and fear, just as they are today. But by 1901, after several years of the stock markets rising strongly, there was no fear. It was just pure, plain and simple greed. The public went mad, betting both long and short. The railway stocks, in particular, were a favourite of the shorts, because to many they seemed to be very overvalued. There was a lot of speculative froth in the railway stocks as the different magnates tried to acquire shares in their rival companies to take control of them. By May 1901, stocks had been rising for months. In the last 7 days of April, they were up 7%. The upwards rush of stocks became even too much for the sane people. Even some gamblers realized that they should be taking profits. On Friday, the 3rd May 1901, stocks took a pause, and then the next day, Saturday, and stocks traded on Saturdays then, stocks plunged 5%, creating a lot of nervousness in the market. The railway market was both nervous and excited. Every topic of conversation at dinner tables and in families and in groups and in clubs over the previous week had been about railway stocks. But there was one stock in particular that was capturing everybody's attention. It was Northern Pacific Railway, which finished the week up 1.5%. On Saturday, 4th May 1901, the stock closed at $110.50. Despite some people being alarmed by the overvaluation of railway stocks, most were not. The New York Times reported that most brokers, even the most conservative ones, were not frightened by the high prices of railway stocks. They could justify the high prices by the huge rise in railway company receipts and by the rise in the US population, which in 20 years had risen from 50 million to 75 million people. However, as prices climbed day after day, the level of apprehension about what lay ahead started to grow. Some investors were getting very nervous. The New York Times, which had previously reported that the high prices could be justified by the future growth prospects, by 6th of May were writing, "This could end in catastrophe." Now we'll turn to the week starting May the 6th, 1901. This week started like any other. Stocks were buoyant, having moved up in London in the morning and now were trading higher to flat in New York. Nobody realized what was about to happen. Within a few days, many speculators were about to be ruined. In the morning, railway stocks were moving higher. But that day, May the 6th, 1901, was about to become one of the most remarkable that Wall Street had ever seen. The overpriced railway stocks were inching higher. But one railway stock stood out from all the rest. It was Northern Pacific Railways. When the stock opened, it opened at $4 higher at $114 and continued to advance throughout the day. There was a frenzy of speculation around this stock. As the more overvalued it became, the more people wanted to short it and take advantage of the coming collapse in the share price. The stock, which had previously been at $110, moved up throughout the day and finally by the close reached $130. Brokers reported that the huge rise in prices of railway stocks was too much for the general public to resist. They reported that all and sundry were now getting involved in stocks, and this even included women and not just the rich ones. The demand to buy railway stocks was so great that the call rate was increased from 6% per annum to 10% per annum. The frenzy and the volume of trading was so immense that the ticker tape was running 10 minutes behind. In those days, people checked the price on what's called a ticker tape, which was a long strip of paper which printed out continuously reporting the latest traded prices. But these ticker tape machines couldn't keep up with the trading and were running 10 minutes or more late. This delay was an exasperating experience for many investors, for the prices they ended up paying was often several percent higher than what they thought they would pay when they looked at the ticker tape. Whilst the general public was in a frenzy of buying any railway stock they could lay their hands on, including Northern Pacific, the smart money was betting against those shares, and Northern Pacific was the favourite stock to bet against because it was so overpriced. So just as a quick explanation, what is short selling? Short selling is when you sell shares that you don't own in the hope of buying them back later. There's two ways to sell shares short back in 1901. Firstly, you could sell shares by borrowing them. You'd borrow the shares from somebody and then sell them. And secondly, you could do what's called a naked short, where you'd basically sell shares you didn't own, hoping to buy them back later. But if you didn't, you'd still have to find a way of delivering the shares you'd sold by borrowing them somewhere else. So the short sellers were everywhere, selling the stocks of companies in the railway sector. And the favourite stock to short was Northern Pacific Railways because that price was the most overvalued of them all. For the most part, the shorts were happy bunnies. As they sold shares, they ended up selling them at much higher prices than the last price they had seen on the ticker tape. Whilst the short sellers were particularly pleased with the prices at which their sales were executed, because of the delayed ticker tape, they were selling at higher prices than they had anticipated. But their satisfaction didn't last long, for the prices of those shares continued to rise. In particular, the price of Northern Pacific, the favourite for the shorts, was rising faster than the rest. With leverage at 10 to 1, the share price didn't have to move fast without a margin call coming in. Many investors were forced to buy back the shares they had sold at higher prices because they couldn't meet the margin call. Other investors decided to sell their other holdings in order to meet the margin call on the most overpriced of all the stocks, Northern Pacific Railways. The next day, Tuesday the 7th, fortunes were made and lost as Northern Pacific shares rose from $130 to $147.50. Trading was absolutely frantic. The stock exchange was chaotic. The next day, Wednesday the 8th May 1901, trading started in the morning normally with stocks making moderate gains. But then the break came. It happened at 1 p.m. Once again, the main riser had been Northern Pacific Railways. But at 1 p.m, Burlington Railways saw their price start sinking. The turnaround in Burlington's share price caused the price of all other railway stocks to fall, and very soon railway stocks were falling in unison. It seemed like every trade would knock 25 cents off the price. As the selling intensified, those $0.25 downticks turned into half-dollar downticks and then a full $1 or $2 on each sale. The mantra of buy, buy, buy had turned into sell, sell, sell at any price. But there was one exception to the selling. And you can guess which one it was. It was Northern Pacific Railway. Whilst the rest of the market was falling like a stone, shares in Northern Pacific Railway continued to rise. So Northern Pacific shares were rising while the rest of the market was falling. And the more that Northern Pacific rose, the bigger the margin calls. And the bigger the margin calls, the more other investors who had shorted the stock had to sell other stocks to raise the cash to meet their margin call. As the Northern Pacific shorts sold other stocks, it pushed the level of the market down further and further. By the end of that day, every prominent stock had fallen, with one exception, Northern Pacific. On that day alone, Northern Pacific had risen another $16.50 to close at $180. Here's an extract from the New York Times as Thursday, 9th of May, and they're talking about the previous day, the 8th of May. I read it to you. The scene on the floor was one of the wildest excitement. The mad struggle to buy and to sell Northern Pacific stock at the opening was startling enough. That afternoon was unparalleled in recent years. Brokers acted like insane men. Men, normally rational and responsible, fought with one another to get their orders executed. Big men threw the little men aside, but with great crying and indignation, these small men jumped back into the fray using their hands, their arms, and their elbows and their feet, or anything that they could to get their trade executed. By the end of the day, on Wednesday, May 9th, there was little doubt in many investors' minds that Northern Pacific stock was the subject of a short squeeze. Longs were demanding delivery of the stock they had bought, but there was no stock to be had on the market. The shorts could not deliver. Nobody was selling, and the shorts were in deep trouble. They needed to buy or to borrow the stock to meet their obligations, but there were neither sellers nor lenders of the stock. Meanwhile, the buyers of Northern Pacific Railroads were demanding immediate delivery of the stock that they had bought, stock which just didn't exist. Such was the shortage of stock in the market that sellers who wished to maintain their short position overnight were forced to pay an extra $70 a day to maintain their position. That was the charge to borrow the stock for one more night. If the previous days had been notable and memorable, May the 10th, 1901, Thursday, was like nothing the market had ever seen. The greatest panic that Wall Street had ever seen was underway. Stocks were crumbling everywhere. At least all stocks bar one. The collapse was so sudden and so ferocious that there was no time for anyone to protect themselves. Speculators could not save themselves. Such was the volume of trades that the ticker tape was running 10 minutes late. Sellers who sold stocks at the market were astonished and dismayed to see that they often sold at prices which were 10% below the price they saw on the ticker tape 10 minutes earlier. Prices were in a veritable freefall, that is to say, all the prices bar one. Many sellers were cast into a pitiless ruin. This was mainly due to the 10 times leverage, where a small change in the stock price of just 10% could wipe out the totality of an investor's money. Wall Street was plunged into the deepest gloom. Securities were being dumped in the market altogether, whole portfolios without regard to value, in some cases through sheer unreasoning fright, in others because the margin calls had been met or the margin had been exhausted, stop loss orders had been reached. It was more than a complete demoralization. It was a general destruction of values, a mad, ungovernable selling moment. The highest quality stocks were down a mere 10%, but the rest were down nearly 50%. An example would be US Steel, down from $47 to $25. Almost no stock except Northern Pacific was spared. The Northern Pacific share price kept climbing. The shorts were becoming more and more frustrated as they sold other things to meet margin calls until they themselves had nothing more to sell. Then they had no choice but to buy back the Northern Pacific shares that they had previously sold. But with every purchase, the share price would jump $1 or $5 or even $10. Northern Pacific shares were going through the roof. There were no buyers of the stock as such because the stock was so overpriced. There were only shorts trying to close their position. But there were no sellers to satisfy the shorts who were buying back their shares, and the price of Northern Pacific started to tick up $20 per trade, and then $30 or $50 at times. The price reached $320, then surged above $400 and $500 in minutes. Within an hour, it was at $650 and still climbing, and the scramble to cover their short positions was a clamour on the stock market as everybody hunted for sellers who didn't exist. Every single share purchase saw the price ratchet up $10 or even $20 at a time. More and more the shorts were forced to sell their other holdings to raise the cash to meet the margin calls on their Northern Pacific shares, which continued to climb higher and higher to unfathomable levels. By the close of business, Northern Pacific shares had reached the unfathomable price of $1,000 a share. Anyone who had sold the shares short at $100 was now looking at having to buy them back at $1,000, and with 10 times leverage, a $1,000 short position, if they could have covered it with margin calls by selling other stocks. A $1,000 short position now represented a loss of $90,000. Fortunes were lost that day. By the evening of Thursday, May 10th, the cat was out of the bag. Two railway moguls, James J. Hill of Great Northern Railway and Edward Harriman of Union Pacific, had been vying to gain control of Northern Pacific. Between them, they owned more than 100% of the available stock. They had been buying up all the available stock and the stock being sold by the short sellers who were selling naked. Naked meaning they hadn't yet borrowed the stock or bought it back to deliver. And these two moguls were not willing to release a single stock to the market. So with more than 100% of the company owned by these two moguls, there was no stock in the market to deliver on their obligations. The short sellers were ruined. The entire financial system was about to be brought down. Banks were exposed to many of the short sellers whose losses vastly exceeded the collateral that the banks held. The entire financial system was facing collapse. Then J.P. Morgan stepped in, not the institution, but the individual, Mr. J.P. Morgan. He rushed to get a court order and an injunction. The injunction forbade the two railway moguls from demanding delivery of their shares. And the court order ordered that all trades, all short trades, be settled at a price of $150 a share, not the $1,000 that the shares had closed at. But unfortunately for many, that was already too late. Many speculators were completely ruined. Sadly, for the hero, or not so hero, of our story, Sam Bolton Jr., the news of the injunction came too late. He was already sizzling in the vat of beer in his brewery. On the fateful day when the stock had soared from $170 to $1,000, Sam Bolton had spent a pleasant morning with his friends. They had taken a ride in the car, had a picnic, and chatted pleasantly. Returning to the brewery, he was met by the runner demanding more collateral. With a very large bet against Northern Pacific and the 10-to-1 leverage, he was wiped out. Sam Bolton then took off his hat and his coat. He placed his wristwatch on the ground and he placed his pocket book on the ground and climbed the ladder to the vat of boiling beer and dived in. Death would have been instantaneous. His friends and family denied that it was suicide. They said that he was not distressed that day, and they said that he had sent an employee away to fetch a carpenter. And while the employee was gone, Sam Bolton climbed a ladder to look into the vat of beer and then slipped and fell into the vat. Such a story would potentially have been plausible were it not for the events of that day on the stock market and the huge losses that Sam had made on the stock market bet. Whilst the death was initially regarded as suspicious, police concluded that it was suicide. The losses that he had made that day and the fact that he had seemingly removed his personal items such as his watch and notebook prior to going into the vat of beer implied that this was a decisive and calculated action. Sam could not have faced the shame that would have come from losing everything when he was such a well-known and respected member of the community and seemingly exceptionally good at finance, but maybe not the best investor when it comes to picking stocks. It's a lesson that even the most intelligent people can make catastrophic decisions. Warren Buffett has cited Sam Bolton's story and said, "We're never going to risk what we have and need for what we don't have and don't need." And my friends, my dear friends, I hope that you'll take this as a lesson. Never take a bet where your losses could be unlimited. If you buy a share, the most you can lose is 100% of your investment. The amount you can gain is potentially unlimited. But if you sell something that you don't own, the most you can gain is only 100%, but the most you can lose is infinity. Never take a bet where the losses could be unlimited. Thank you very much. If you enjoyed this story, please like and subscribe, and I'll be telling a lot more stories like this so you can benefit from my knowledge and experience.